The stock market keeps breaking new record highs, but now the stock market rally is starting to make investors anxious according to Yahoo Finance. Let me show you what I mean. The stock market has averaged a 12% return a year for the last 50 years. But recently, the market has been outperforming the historical average. Over the last year, the stock market grew by almost double the historical average, and over the last 5 years, we've also seen the stock market grow a lot faster than the historical average. Now here's the thing. Above average stock market growth is not a bad thing, assuming the economy is keeping up. Now remember, the stock market and the economy are similar, but they don't always move in the exact same direction in the short term. But as you start to look at the stock market and the economy over the long term, you want to start to see them move more in a similar direction. And what we're seeing is that over the last 5 years, we've seen the stock market grow at above average speeds, while the economy has been growing at below average speeds. In the year 2024, our economy, our GDP, grew at a rate of 2.8%, which is below the last 50-year average, which is around a little bit over 3%. And over the last 5 years, between 2019 to 2024, the United States economy, measured by GDP, grew by 2.68%. So our economy has been growing at a speed slower than the 50-year average, while the stock market has been growing faster than our 50-year average. Now you can start to see why some people are starting to get nervous about the stock market. But before we get ahead of ourselves, I want you to really understand what's going on by studying 3 things. Number 1, understanding, is the market actually overvalued? Number 2, why has the stock market been booming in general? Yes, we've been seeing a lot of volatility, but in general, why is the market still so high? And number 3, how do you actually win in these volatile markets? Now, I gotta give you a quick disclaimer. I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now, to understand if the stock market is overvalued, I want to take a look at 3 things. I want to compare the stock market to the economy. I want to take a look at the fear and greed index. And then number 3, I want to take a look at actual stock market valuations and compare it to the historical. And if you don't understand what this means, stick with me. Let's start here by taking a look at the economy, which is measured through a number called GDP. Well, lucky for you, we already did that analysis. That's how we started this video, which is where we compared the stock market growth with the economy growth, because remember, the economy is measured through a number called GDP. And what we're seeing is that the stock market over the last 5 years has been growing faster than the historical average, while our economy in the United States has been growing slower than the historical average. So you can start to see a little bit of a diversion. That was quick and easy. Now let's talk about the fear and greed index. The fear and greed index is a measure to show how investors feel about the market. Do people feel scared that the market might be falling, or do they feel excited that the market is going to make them a lot of money? Now you might hear that and say, why do people's opinions and emotions about the stock market matter? And the reason why it matters is because the stock market is extremely emotional. See, the stock market doesn't always move on logic. It moves on people's emotions, because you have the easy ability to buy and sell stocks off your phone, and that applies to hedge funds, wealthy investors, and regular people. And so when people feel excited, they're more likely to buy. When people feel more scared, they're more likely to sell. And what we've seen is that generally when markets are going up, they tend to build bubbles because people get extremely greedy, they get extremely excited. When markets go down, we tend to see a very big bubble burst because people freak out. They have fear, and that forces people to sell even when they shouldn't. And according to the Fear and Greed Index, investors have been becoming more bearish week after week after week. By the way, bearish means investors feel that the market is going to go down. Bullish means that investors feel that the market is going to go up. So when we compare the stock market to the economy, we see the stock market is growing faster than the economy. When we take a look at investors' emotions about the stock market, more people are believing that the stock market has a chance to go down. But now let's actually take a look at the numbers. Let's take a look at the valuations. The big buzzword here that everybody on Wall Street loves to talk about is multiples. How many times earnings is a company selling for? And they can make it seem very complex, but let me break it down to the most simple level. Let's assume that I have a company that makes a profit of $100 a year. How much are you willing to pay me for a company that's making $100 a year of profit after all expenses? Now the answer is, it depends. It depends on what multiple you're willing to apply to me. Some of you might say, I'm not going to give you more than $100. Well, that's a 1 times multiple because you take my profit, multiply by 1, that gives you the $100 valuation. Others of you might say, I'm willing to pay you $1,000 for this company that's making $100 a year of profit, which is a 10 times multiple because it's 100 times 10. So your multiple is how many times profit, otherwise known as earnings, how many times profit is this company actually selling for? Now, when we talk about what is the company selling for, this is known as the company's market capitalization. This is the essentially net worth of the company. What is the valuation of the company? Now, your natural next question here might be, well, Jaspreet, I don't really care what my bro cousin Bunty is willing to pay for this company. What I want to know is, what is a good multiple? What is a good valuation? And let's do the same analysis that we did for everything else. Let's take a look at the historical versus what's happening right now. Over the last 50 years, the average multiple for companies in the S&P 500, the stock market. By the way, the S&P 500 is a group of the 500 largest companies in the stock market. So the average multiple over the last 50 years has been 15 times. Meaning if you make $100 of profit, you take the number, multiply it by 15, and that means that this company is worth, quick math, $1,500 because you're paying 15 times profits. So how are multiples looking today? This is where I did some digging, and what I found is that as of February 2025, the average earnings multiple for the S&P 500 is 30 times, which is twice what the historical average is, which means right now, instead of paying $1,500 for this company that's making $100 a year, investors are paying close to $3,000 for that same company. But historically, the average would have been $1,500. Now, I do want you to take this number with a grain of salt because it's an average, meaning there were times where multiples were a lot higher and times where the multiple was a whole lot lower. Like through my research, what I found is that around 2008 time, multiples were over 100 on average. And with that, we can check this off right here. So what have we found out so far? That we have seen the stock market move at a faster rate than the economy. We have found that there is a more and more fear emotion coming in the stock market. And we have seen that valuations on average for the stock market have gone up compared to the historical average. So now we understand this. Is the stock market overvalued? Again, this is going to be subjective, but we have to get a little bit deeper to really understand this. So let's talk about why markets and stocks have been selling at higher valuations, at higher multiples than what we've seen in the past. Now, this is one of the reasons why on March 11th, 2025, I'm hosting a free workshop where I'm going over how you can capitalize on all these changes that are happening in the economy right now, because we're seeing a lot of changes with tariffs. We're seeing a lot of changes with Doge. We're seeing a lot of changes with Trump economic policies, and we're seeing a lot of changes with technology. And these changes are moving faster than what a lot of people expected, which is why on March 11th, I'm hosting this free live and virtual workshop where I'll go over not only what's happening, but how you can capitalize on these investment opportunities, because all of these things create investment opportunities. If you want to join, all you have to do is register. I'm doing it twice on March 11th. Once in the morning at 10:30 a.m. Eastern Standard Time, and then again in the evening at 8 p.m. Eastern Standard Time. You do have to reserve your spot because we have a limited number of people that can actually join me live. So if you want to join me for free, I got the link for you to do so down in the description below. Now, to really understand why markets have been booming, let's go back to the roots and understand what caused the stock prices to go up. And some people will say, well, it's because companies make more profits. People will say, well, it's because they're innovating better. People will say, well, there's more access to the markets. But if we really understand the core, the reason why stock prices go up is because you have more buyers than sellers. When you have more people buying the Apple stock than selling the Apple stock stock price is going to go up. So it ultimately goes to supply and demand. When you have more buyers than sellers, stock prices go up. When you have more sellers than buyers, stock prices go down. So what causes demand to go up or down? Well, if a company is making bigger profits, you generally see more demand than supply. I say generally because you have to also see the buyers. A company could be seeing growing profits, but you might not have people that are buying because people are in a recession, they have no money to buy, so you might not see that big boost in demand, which is why you could see profits go up and not the stock price go up. What else could cause demand to rise? Companies innovating, or a new hype or publicity, or an idea that We're going to use new artificial intelligence. We're going to create a new quantum technology. All these things can get people excited, and that excitement can create more demand even if the company isn't making more money. So the reason why stock prices go up is when you have more buyers than sellers. And what have you been seeing, especially over the last few years? Number one, which is arguably the most important and one of the most overlooked, is we saw a whole lot of money get printed over the last 5 years. Between 2020 to 2022, a lot of money was printed and entered our economic circulation, and a chunk of that entered the stock market, which allowed for more demand just because there was more dollars out there. Number two has to do with access. It's very easy now for more and more people to access the stock market. I'll show you what I mean. In 1990, about 25% of American families directly owned some stock. 2025, about 58% of American families directly own some stock. The reason why it's much easier to go out and buy stocks today than it was back in the early 1990s, which has helped lead to more demand because more people can go out and buy stocks whenever they want. And then the third part is we also have a lot more young people going out and buying stocks, which is really a direct result of what happened during the pandemic, because during that time, Robinhood came out and they capitalized on younger people who wanted to trade, who wanted to get into the stock market. And we saw this huge boom of young people under the age of 35 entering the stock market like never before. So we have more young people entering the stock market. We have more people in general that are buying stocks on themselves. And we also have more dollars out there, which has helped the stock market boom, because all this created the perfect storm for people to go out and invest more money into the stock market, which helped the stock market boom. But this is where I want to give you a little piece of advice as a random guy on YouTube, so take it for what it's worth. Markets do not always go up. We know that the stock market has averaged more than a 10% return a year, but that does not mean that the stock market always goes up. We have seen recessions, we have seen market crashes. They are a part of our economic system. So let's do a pop quiz. How many recessions has the United States seen in the last 100 years? Take a guess. The answer is 16 recessions over the last 100 years, which means we are averaging more than one recession a decade. Here's another pop quiz. How many bear markets has the United States seen over the last 100 years? A bear market is when the market is falling down, generally more than 20%. How many times have we seen that happen over the last 100 years? The answer is 25 over the last 100 years. Markets go up, markets go down. The last few years have been essentially straight up. Yeah, I get it, 2022 wasn't the best, but the last 5 years have overall been a booming time for the stock market. And the reality is markets go up and markets go down. It's a part of our economic system. The problem is nobody knows when markets will go down. We don't know if it's going to happen this year, next year, in 5 years, in 10 years. We know that it will happen, but most people always get caught into this trap that markets are going to always go up. They go up over the long term, but they don't always go up each and every year, which is why you have to understand now, how do you win? Now that you understand the valuation of the stock market, and you understand a little bit more as to why the stock market has been booming, let's talk about how do you actually win in this stock market. That way you could be one of the people that are building wealth instead of one of the people that are just selling your stocks, making somebody else rich. When I talk about how do you win as a stock market investor, I mean how do you actually make money in the stock market, because unfortunately, a lot of people end up losing money in the stock market despite the fact that the stock market has rallied by more than 10% a year on average. But here's what you got to understand. The first mistake that most people make is they say, I want to make money in the stock market, and then they say, what stock should I buy? Which is the wrong game plan. The first thing you got to figure out is, what is your strategy? Do you want to be more of a passive investor, or do you want to be more of an active investor? You have to know your game. A passive investor is somebody, in my opinion, in my words, is somebody who's investing their money into the broad stock market, into the broad American economy. So earlier in this video, I talked about the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Well, you could just go out and invest in these 500 companies. Yes, you could go out and individually buy all 500 of these companies, but that's going to take a ton of time and a ton of work. There are funds out there that will give you exposure to the S&P 500, so you don't have to go out and try to find the next Tesla or Nvidia or Amazon. You can go out and invest in an ETF like SPY. This gives you exposure to the S&P 500. Again, I'm not telling you what to invest in, just giving you examples. If you buy one share of SPY, you're getting exposure to these 500 companies. You could also invest in another one, VOO. I'm personally invested in VOO. This is also an ETF that gives you exposure to the S&P 500. Same thing. So now, instead of going out and investing in each one of these companies individually, you can just invest in an ETF that gives you exposure to the S&P 500. The reason why this is good for many people is because you don't have to worry about trying to keep up with companies. You don't have to listen to earnings calls. You don't have to try to value companies. You don't have to try to find the best stock. It's a set it and forget it strategy. It's less risk than doing this, because if you invest into Amazon and Amazon goes bankrupt, all of your money goes to zero. You might say, well, Jaspreet, Amazon's not going to go bankrupt. It's one of the biggest companies in the world. Well, people said the exact same thing about Sears. Sears was one of the largest retailers in the world, and many people said that nothing bad could ever happen to Sears. And look at where they are today. They're bankrupt. Times change, technologies change, investments change. And if you're not willing to keep up, being a passive investor is a much easier option. Now, the way that you win as a passive investor is not by investing your money every once in a while. It's not by trying to time the market and finding a great time to come in and buy. It's by following a strategy that I call ABB. Always be buying. You want to set up an automatic system. If you want to be a passive investor and win, you set up an automatic system where every week or every 2 weeks or at the very least every month, money is pulled out of your checking account and is automatically invested into your portfolio of funds. Maybe you want to invest in the S&P 500. Maybe you want to invest in the Dow Jones. Maybe you want to invest in the total stock market. Maybe you want some dividend-paying ETFs. Maybe you want some tech or healthcare or whatever ETFs, doesn't matter. You create your portfolio of funds that you want to invest in, and then you ABB. Every week, every 2 weeks, or every month, you set it and forget it. Money is automatically pulled out of your checkings account and is automatically invested, whether it's raining outside, whether it's sunny outside, whether the market is booming, whether the market is crashing, whether it's Trump, whether it's Biden. You just keep buying. You don't worry about everything going on out there. You don't worry about Doge. You don't worry about tariffs. You don't worry about AI. You don't worry about any of that stuff. All those headlines can just go over your head. Because now you're just investing in the American economy, and you're going to wait for the American economy to continue growing, because we know that the American economy is strong. And if you continue to believe that the American economy is going to continue to be strong in the future, you can just be a passive investor and invest in the American economy, have less risk, less potential return, but very little actual time and work. You just set it and forget it. And this has been proven to build a lot of wealth. For some of you, you might say, this is great, but I also want to be an active investor, or I want to be more involved as an active investor. Active investing is now you're trying to find a shift. You're trying to find where the money is moving. You're trying to find an industry where a lot of people don't know about it yet, and you want to go in and invest in this thing. That way you can see a lot more growth. It's more risk, but more potential return. This is like you trying to find the next NVIDIA before everybody knows about it. You're trying to invest in Amazon before everybody knows about it. More risk, more potential return. You could invest in a company that makes you a ton of money, or you could lose everything, or something in the middle. So you can start to see now how you're taking on a lot more risk here, but it also comes with more work. This is why I say this is not for everybody. This is only for some people. And there are a lot of things that you can do to study these, what I call market shifts. For example, there's a lot of, there are so many changes happening in the economy right now. This is prime time to be an active investor. And when I say active investor, I don't mean trader. I mean active investor, investing for at least a year, because there are so many changes happening. Doge is changing a lot of things. Doge, for example, they want to upgrade the technology in the White House. What does that mean? Well, companies that are providing that technology to the White House could be seeing huge contracts. That creates a potential investment opportunity. Trump has been talking about deporting millions of illegal immigrants. That creates an investment opportunity. Why? Because private prisons are making money because of that. Trump has talked about investing in the military. Who does it benefit? Military-related companies, defense-related companies. Trump has talked about deregulating financial services. What does that do? Benefit the Wall Street companies. I'm not saying this from a political perspective. I'm saying this so you understand every move that happens in our economy has an impact in markets. And what everybody on Wall Street is doing is they're not getting caught up in the emotions, is they're understanding how does this create an opportunity. This is what I'm going over on March 11th. I'm going over what are the changes that are happening through Doge and tariffs and the Trump policies and AI and technology. How do these things create an investment opportunity today in 2025? Again, not for everybody, but more risk, more potential return. You could be wrong. I mean, you could identify a shift, but pick the wrong company. You might say, yeah, Wall Street is going to be deregulated, and invest into a Wall Street bank, and Wall Street banks make a ton of money except yours. Yours runs themselves into the ground and your company goes bankrupt. more risk, more potential return. This is where you have to understand, number one, what is the shift? Where is the money moving? How is the money moving there? And then you want to know, well, what about the company that you're considering investing in? Is that actually a good company? How are they managing their balance sheet? What does their profit and loss statement look like? This is what I'm going over on the workshop. Again, it's on March 11th. I have the link for you down in the description if you want to learn more. But just understand active investing, more risk, more potential return, more work, more time, more research. This is not just find a random stock on Reddit and go out and buy it. That's a recipe to make somebody else rich. I want you to know the game. If you want to win, you have to know how to research. You have to know how to study. You have to know how to actually analyze. And that's the work and time you have to do here. If you're not willing to do that, just be a passive investor, right? This is less risk, less potential return. We know that this has been proven to win over the long term. Yes, there are down periods. During the 2020 pandemic, markets went down. 2022, markets went down. 2008, markets went down. 2000, dot-com bubble bursting, markets went down. But over the long term, markets have gone up. There are periods where markets don't go up. There are periods where markets go sideways. There are periods where markets boom. But over the long term, on average, markets have gone up, and this is how you can be a steady winner. Yeah, you're not going for the big wins here, but you're just trying to get the slow and steady returns, which is great for 98% of Americans. If you want to be more involved, this is an opportunity for you. But again, it takes more work. So let's put this all in perspective right now. Are we seeing the stock market overvalued? Well, I think a lot of people will tell you that yes, the stock market is overvalued based off of all the things that we're saying here. But the reason why markets have gone up so much is because what we talked about here. We've seen so much more money enter our economic system. We have so many more people that have access to the stock market. And now we have a whole new demographic of people that are trading and buying stocks through younger people. And this has created a whole new wave of money entering the stock market, which has helped the stock market boom. But now, based off of all that, does that mean that the market is going to crash tomorrow? No, not necessarily. Nobody knows when markets are going to go down. We know markets go up and we know markets go down. We know that economies go up and economies go down. We know that there's a ton of volatility right now. I mean, you could talk about tariffs or Doge or AI. All these things create uncertainty. Stock markets don't like uncertainty. Even the Federal Reserve Bank is confused. But over the long term, if you believe in the American economy, that's still a place that you want to invest in. But the question is how? Do you want to invest in individual companies as an active investor, take on more risk for the more potential return? Or do you want to be more of a passive investor and just invest in the markets and let the markets do their thing? Once you understand your strategy, then it's all about executing, and that's how you win. Now again, I have some resources for you down in the description. I have number one, my workshop, which is on March 11th. And then for those of you that are investors and you want to stay up to date on what's happening in the financial markets, we have a free newsletter that my team at Briefs Media publishes every day called Market Briefs. It's completely free, and we keep you updated on what's happening in the economy, stocks, housing, crypto, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that read every day, and I have that link for you to join for free down in the description as well. You have no money in case your car breaks down. You have no money to pay for your health insurance, and I'm assuming that you're putting no money aside to invest, to build your wealth. Now you can start to see the problem. Now here's the real catch that most people don't learn until it's too late. It's not your income that will determine if you become wealthy or not. It's what you do with your income.